Greetings traders and welcome back. Thank you for joining me again as always. Chris here bringing you another survival guide. Today's subject will be price action. We're going to talk about what price action is, and then we're going to dive into some visual representations of price action patterns. That way, at the end of the video, you'll be able to begin hunting for these patterns and adding them to your trading arsenal. I see traders passing the gauntlet mini with the help of price action patterns, some of which we'll be covering today, and I am excited to bring these to you because I myself am a big TA trader. But without further ado, let's dive on into it. Price action is one of the core concepts that is behind the idea of technical analysis. It's paying attention to the historical path of price and using that historical information, what it did in the past, how it responded, as a way to get an idea of what to expect in the future. So what is price action by the book? Well, price action trading brings together an interesting mix of information and different views. These include the historic price patterns like we discussed, as well as technical indicators. And this gives us the ability to potentially read the market, or at least that's what we're going for. Many investors see the stock market or the Forex market or the futures market as nothing more than an information exchange where all views and strategies meet to try to arrive at a fair price at the end of it. Price action trading strategies do not involve fundamental analysis, so they don't really care so much about earnings reports and various other things in that regard. Instead, it's focusing on the raw data of where things were. The key to reading price action charts is to take in short-term fluctuations as well as emerging trends and focus on patterns that are repeated time and time again. And this is something to really focus on here. What we're doing with price action is paying attention to the ebbs and flows that the market makes. And when we notice certain patterns or certain behaviors exhibited, as well as the response that came thereafter, we're focusing on the outcome after this pattern has been created. The history behind how often the outcome occurs is very important with how interested we are in finding these particular patterns. If we exhibited a bullish outcome after a particular pattern, say 72% of the time, that would be a very valuable piece of information for any trader to have. That way, when they notice the pattern, even though it's not guaranteed to be bullish momentum thereafter, they have a 72% expectation based on historical data as to why they may expect bullish momentum thereafter. And as traders, any type of edge over the market can be something that can translate into a very profitable gain if done correctly. Next, we're going to cover some of the most commonly occurring price action patterns that other traders have already put in the work and research for you. These are the widely accepted patterns that many traders use on a daily basis with accepted outcomes. This price action pattern is called the bullish head and shoulders pattern. And this here, the head and shoulders concept, is my favorite price action pattern of all time. So if there's nothing else that you take away from this video, I hope you learn the head and shoulders pattern. Essentially what we have with the bullish variation of this pattern is a downswing in price where there's a sell-off occurring. Now there's a short-term support that is built at some point during this sell-off, leading to a temporary retracement which then finds stiff resistance. After the resistance, we have another push downwards where the sellers that were already in are continuing to push lower, or the sellers that didn't get a chance to get in up at the top are trying to take advantage of hopefully more bearish momentum, and as such they push price lower. Well, what happens is eventually we're going to find some type of equilibrium where price is pushed too low and the market is viewing this as a fair price, and as such the buyers are more interested at this point than the sellers. sellers and price begins to go back up, where it encounters resistance one more time at the same location, which is referred to as the neckline. The neckline is an area in the market, once again, that these two shoulders are going to come to. The head is always going to stick out farther than the shoulders. After the second hit of the neckline, we're going to swing down one more time, and finally, when we return to the neckline, we're hoping for the break right here, and with this break, we are now expecting bullish momentum. If this pattern were to be completely inverted, there is an exact identical variation of this called the bearish head and shoulders. So if you just flip it around, it would look something akin to this, where we have our shoulder, then our head, followed by our shoulder again, and then a break of the neckline. And this is, once again, one of my favorite patterns there are. Our next pattern is another extremely common pattern, and this one does occur quite frequently on all assets, on all charting types. It is called the double bottom, and what we have here is a situation where we're expecting price to be falling and then finding support. After support, we expect a retracement that is encountering resistance, and then a fall back down to that area where we found support the first time. After this, we have now created the term the double bottom because we have 1 and 2. After the second find, we're going to work our way back up, and what we're looking for here is an entry when we break the first area of resistance that we created after this first area of support. The triple bottom is quite obviously very similar to the double bottom, but the only difference is our break of this initial area of resistance doesn't occur until we have hit bottom 3 times. This can essentially go on over and over and over again, but these are the correct names that the trading community will attach to this type of a pattern. But obviously we could have a quadruple bottom, a quintuple bottom if we so found one, but they are less common than the double and the triple. The double bottom is far more common than the triple, but the same thing applies here. We're expecting price to be falling, finding support, then finding resistance, returning to the initial area of support, returning to the initial area of resistance, then returning to the initial area of support one more time before breaking through this area of resistance. And once again, it's the break that we're looking for here, because at this break, that's when we're looking to enter. So we don't have to get too concerned with whether we're correctly identifying a double bottom or a triple bottom or a quadruple bottom or what have you. It doesn't matter. The idea here is to pay attention to the point at which the resistance that we created off of the first show of support has broken. Next up, we have the rounding bottom, and this one is a little bit harder to identify for new traders because it's easy to look at as I draw a curved line around this, but if I were to remove that line, it becomes a little bit harder to understand that we are seeing somewhat of a curve here where our highs are getting lower, then our highs are getting higher, and our lows are getting lower, then our lows are also getting higher. That is the key thing to take away with the rounding bottom. We were watching bearish momentum come into this, and remember, when our highs are continuously getting lower, that is a sign of bearish activity, and the same is true when our lows are continuously getting lower. But this transition that occurs where our highs are now getting higher and our lows are now getting higher is the change that we're looking for. And at this point, we're usually interested in looking for a buy when the first peak has broken, which would be somewhere right around there, and we're looking for that long opportunity on the way back up. The bullish island reversal is another pattern that is difficult to spot for newer traders, but it does occur more frequently than you might think. Now, there is a weird caveat with the bullish island reversal, which is where the name island is coming from. The name island is coming from the fact that there's a gap down and a gap up, as this creates a little bit of a price island. So what we need is price to be coming downwards for this bullish variation, and once it's fallen to a point where it all of a sudden picks up a ton of momentum, it may gap. And when it gaps, it is now down in an area that has some space in between the last located price, and we are going to travel around in this location and almost give ourselves a bit of a rounding bottom scenario where we're seeing a transition from the bearish momentum to the bullish momentum. Now the key here is on our way out, we want to see another gap. Just like we gapped into the island, we want to gap out of the island. After gapping out of the island, the pattern is complete, and at this point, we'd be looking for an entry to go long. The bullish wedge is a relatively frequently occurring pattern that is beginner friendly because it is quite easy to spot. It has some characteristics about it that we should talk about, such as the fact that once we form our first peak of resistance during a bullish market, we're going to expect a downfall. Now, once we have this downfall, we're not overly concerned until we set another peak that is lower than the first peak. And after we set this second peak, we want to set another low that is going to be lower than the first low. And what this does is it kind of encases the trajectory of price. It seems to be getting tighter, just like a wedge. It is coming to a point at this point in time. Now, it never actually reaches a point because we anticipate a break to occur before it actually comes to a point. So when it breaks, which usually we want to see it break to the upside, we'd be looking for a long opportunity thereafter. The bullish flag is traded very similar to the bullish wedge, but the big difference here is the fact that with the bullish flag, we don't see it tightening in on itself. With the bullish wedge, we were watching price come in on itself just like this. The lows were getting lower, but the highs were also getting lower at a rate that was causing it to squeeze in. With the bullish flag, we still will watch the highs get lower, and we'll watch the lows get lower, but the big difference here is that it's doing it at an equidistant rate. So with the flag, we expect to see price kind of working its way in a slightly downward sloping range-bound market, if that's the way you want to think about it. But the concept here is strong bullish momentum went into the creation of the flag, so we're anticipating a break of the top trend line of the flag and looking for that as an entry opportunity to rise, just like we're doing with the bullish wedge. The only difference is this pattern forms itself slightly differently. Next up, we have the bullish rectangle, and this one is going to be another situation where we're paying attention to the highs and the lows, creating a centralized area of support and resistance, and then ultimately breaking out and returning the direction of the overall trend. So this means that if we were traveling upwards before finding resistance, and then we found support after we got knocked downwards for a correction, and then we just kept pinging back and forth between these two rough areas of support and resistance, we're looking for the break to the top side, preferably speaking, because at that point, this is the time where we're anticipating that the market has been filled up with enough buyers, and the buyers have become aggressive enough that they're breaking away from this stagnation point, almost a period of consolidation, and have gained the volume they need to maintain and continue on with the overall bullish consensus. The ascending triangle is another pattern that is once again going to be a continuation pattern in the sense that we are looking and hoping for a break to the side of the direction that we were going in before the pattern was created. So once again, this is another pattern that can be completely inverted. Every single pattern we've shown thus far can be inverted for the bearish variation and is traded exactly the same way. It's just an upside down version. So with the ascending triangle, we want the bullish momentum going in, encountering resistance. Now, the interesting thing with the ascending triangle is that the resistance area is meant to be the same. That means our first hit of resistance should be roughly where our second hit of resistance is after we have come down and found some degree of support sending us back towards that resistance. So we want to see this initial area of resistance hold for at least two tests. So we have our first test here, we have our second test here. After this point, once we see the lower area of support followed by the higher area of support, giving ourselves a bullish trend line, climbing its way upwards, tightening in on this area of resistance at the top, we're waiting for the break in this area of resistance and looking for that long opportunity. Price action patterns are a ton of fun to trade and can be very profitable tools to utilize when you become proficient with them, but it isn't the only aspect of price action trading. It should be noted that resistance and support are both just generalized uses in the price action world. We want to be good at identifying areas of resistance as well as areas of support, because at any given moment there could be a valuable trade to be had just based on support and resistance alone. Now, we we always encourage that you use outside knowledge or other confirming factors when making trades. But if we look at the E-mini S&P 500 today, for example, we can see that we noted an area of resistance right over here where we essentially formed a triple top. If we were to inverse our triple bottom, we now have the triple top. And what happened as we reapproach this area if we look all the way over here to the left? Well, when we reapproach this area, we found more resistance, but it wasn't so strong. We can take that as an indication with this prior bullish momentum going into it that we are ultimately looking to break through, and we can be ready for that break when it finally happens. When we're finally breaking through and finally trading above that area, we can then utilize that as information to potentially go long. In this scenario, the market has gone up from that point, so we would have been able to scalp some gains from it, but then the market kind of ranged sideways. But there are support and resistance areas all over any given chart at any given time, and it isn't something that we want to neglect. Price action patterns themselves are awesome, but remember, price action trading also includes just generalized areas of resistance and support. But until next time, folks, I hope you have a great time taking your Gauntlet Mini Challenge. Best of luck to all of you, and I will see you all very soon. But wait! Please, before you go, click the like and subscribe button down below. Do me a favor, and I will see you soon. Thank you, folks.